You're about to join Jerry Parker, Moritz Seibert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kaastrup-Larsen, are back with this week's edition of the Systematic Investor series, where we share our experiences, the ups and the downs of what it's like to be a rules-based investor, and of course, where we take your questions. And as usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Good morning. Good afternoon, Niels. Good morning, Jerry.
Now, before I forget, I want to mention that next week, the technical gods permitting, we will be joined by the one and only Mep Faber, which we are very excited about, and we hope that you will send us some of your questions for Mep in the coming days so we can prepare all of that. Now, this week, we saw some strong moves in some of the sectors. Energies in particular were incredibly strong. I'm just looking at the screen here, almost 9% up move in gasoline. So that's definitely a strong week. But all the other energies did well as well. And we had equities, which also had a nice tailwind. And fixed income markets probably a bit soft as far as I can tell. And so were some of the grains. At least that's what I sort of picked up. So why don't we just do as we normally do? Jump into it, see what happens, and maybe start out with you, Moritz, just to see how the week went from your trend following perspective.
Yeah, happy to do that. So finally, a positive week, albeit small, but I'll take it. Energies, just like you said, Niels, they've been great for the portfolio. Long gasoline, long in crude, all of that was good. I'm now less short in some of the equities. Still have some shorts on, but they're getting smaller, moving much more toward the long side now, which was a good thing in the past week. Bonds didn't really do that much. They went a bit softer, but not really that much of a problem there. And the dollar just again fine for me. So all of that has worked, and like I said, a small positive week.
Good to hear. Very nice. Bit of the opposite on our side. Again, I think it's interesting to see how two trend following approaches are a little bit different. So we had a little bit of a soft week this week, gave back about 25% of, not 25%, but 25% of our month to date gains. So up a little bit more than 3% for the month so far, but we lost about 1.5% this week. And, but so our week was really, the big winners for us was wheat, coffee. Did really well. We also made some money from currencies, but not all currencies were good to us. The yen was, Swiss franc, and the euro was pretty good. But the difficult markets for us was really the energies. I mean, the strong moves that I mentioned in the beginning of energies are not helping us because we have a short bias there. And of course, fixed income. The soft fixed income markets didn't help either since we are generally long. And of course, with equities, although we are starting to get a bit of a mixed bag of positions, we did see an overall small loss in equities from a net short bias. So yeah, nothing too dramatic. The month is still looking okay, but the week, unlike you, Moritz, we had a bit of a negative week. But of course, we're always excited, Jerry, when we come to you to hear what's happening in the single stock or any other interesting markets that you had in your portfolio this week.
Well, the palladium and cattle are still fun positions for me. Did see some weakness and positive performance from the grains. Canola almost made a new low. So we've been short a lot of the grains for a long time and have been chopping around, but maybe they'll hit new lows. Looks like gold might be a long for us soon. We got run out of our short, and so now we're longer term on our entries. I was looking at the energy charts, and I'm not going to be long those for a long time. So a little more longer term, turning around the positions. I went through all the indices, sub indices of the stocks, and the charts look similar, but the individual markets look a lot different. The ones stand out this week. Real estate made new highs, I think, the S&P real estate index, whatever. So, but we're buying stocks. We have a very diverse basket. No shorts. All the markets are sort of strong, but we are actually hitting our entry criteria and been able to put some longs back on. Looks like the European, Swiss, Euro, Sweden, they're weaker than Aussie, Canada, and New Zealand. And we may be in some of the more exotic ones, maybe turning around, could be a long. That would be really good to go from 100% short currencies to more of a mixed bag. I'm sort of looking forward to that.
Yeah, no, absolutely. I mean, it always feels a little bit more scary when you're sort of fully committed, throughout the whole, list of markets in one or two sectors. So I agree with that. I know we have a lot of questions, which is great. Thank you so much. And do keep sending your questions to info@toptradersunplugged.com. That's fantastic. So we're going to focus on those today. But before we do so, we also want to find out what happened in the news flow, meaning who like, or how many likes and shares did we get in, or did you get, Jerry, in social media land? What stood out in the Twitter world?
Pretty quiet week this week, so I just mentioned a couple that kind of fits in with our strategy. One that caught my attention was the importance of having a story to tell your investors, whether it's about technology and your use of technology, or being able to explain. And so we kind of come lacking in that area sometimes, where we don't really have a story. I changed my Twitter setup this week to where I just sort of replaced some things and said Chesapeake ... the place you're not going to get a story. There is no story here. So I don't know if that helps at all. I did pick up 500 followers in one day. It may be a lot of algos out there giving me a lot of fake followers. I'm not sure how this happens, but
wow.
Yeah. So anyways, this caught my eye. Everyone is always looking for a story for why they're doing what they're doing. And many of those stories aren't robust. The management fees are so large that if you can sustain a story, you can manage assets for a long time and make big money without having to perform well. So I don't know what our story needs to be, other than, hey, we don't have a story.
I mean, I think that's great, especially coming from you, Jerry, because you do actually probably have the best story in trend following. And that, of course, the turtle story that everybody, I'm sure, listening to this podcast is familiar with. But I agree with you completely. I mean, I think that's one of the challenges, that we're not very newsworthy in terms of the strategy. And therefore not very exciting for the media, except when there is something negative to write. They, funnily enough, seem to be picking that up pretty consistently. So, but I agree. But congratulations, 500 new Twitter follows in a day. That's pretty amazing. That's a story in itself, I think.
Funny. So many times I get great emails or text messages from friends and listeners, and I get their permission, and I tweet it, and I try to make sure people know it's not mine. So I'll put some cryptic initials and stuff down there, but it's so good. And so this comes from a good friend of mine in New York, and he's a trend follower, and probably the first person every week to tell me that he liked the podcast. And so he's a very, very good trader. So this is what he sent me. CTA is a bad word. I've watched the laughing at CTAs and think, this is about the only alternative investment strategy around for the past 50 years. And the big name macro guys are trend followers, even though they don't disclose it. And then I finish it by saying, being around quote unquote, is important.
And interestingly enough, a lot of these people, they always refer to the importance of long-term compounded returns and the positive effect that has. And actually, some of the longest track records, as you rightly point out, that has provided that long-term compounded effect are indeed from the systematic trend followers. Not that, as far as I know, there's not that many discretionary guys that's been around for 30, 40 years. Yeah, very important message.
And at the end of the day, the bottom line to the risk management and the strategy of diversification and small losses and holding on to mega winners is about preserving capital and staying around, even though the past few years can be difficult and can be highly criticized. And it is sort of the ultimate that you do want to have a long-term track record. That in and of itself is sort of a mandatory goal.
Yes.
I mean, it's funny. To me, it's always been a little bit like, with when Apple launches something new, right? The latest, greatest gadget. And I don't know, maybe it's a bit unfair, but I think there's a little bit of a tendency, even for investors, to always be looking for something new. Whether it's better is not, but the fact that it's new seems to be a positive. Yet, in my mind, having something that's been around for a long, long time and proven it's been, successful in that space, in the investment world, I think it's nice to have something that's a little bit old and tried and tested rather than something brand new that may not have seen some of the investment environments and regimes that we have through our careers. But
yeah, the grass is always greener somewhere else for most investors.
That's true. That's true. What else did people like, Jerry, this week?
Well, probably the most popular one for my followers, of course, was one by my friend, another New York friend, Mike, who is a friend of the podcast and who we kind of all know. So he posted on his blog a lot of charts over the past few years, just kind of showing that there hasn't been trends over the past few years, except maybe the stock market. So that, of course, I think it's an excuse. It can be used as an excuse. You should try to figure out how to make money, even if the markets are choppy or they crash or there hasn't been trends. But I haven't been able to do that. And I've always been eventually bailed out by mega trends and continuing to have an approach that was reliant upon those trends. And he sort of writes, lots of markets haven't moved. That's why we haven't made money. The charts tell the story. For trend followers, no trends means no profits. And, sort of diversification fail. The majority of people think that I have a lot of stocks and a few bonds and I'm incredibly diversified. And of course, we take another approach of currencies, commodities, interest rates as well, long and short. That's a safer, more robust, longer, and in the longer term, it's had better performance with smaller drawdowns. So our time will come, but it is sort of helpful to see that we haven't really had system failure in that we haven't had trends in the markets that we weren't able to capture. We just haven't had trends.
Absolutely. I mean, first of all, I would say, yeah, I liked Mike's blog post. I think it's very powerful if you can show and explain certain things just with a few visualizations, and those 5 or 6 charts certainly in my world does just the job. And I think that's kind of the message as well from our side at the moment when we talk to clients and potential clients, and just to explain to them that, when you look at these sort of major asset classes represented by 1 or 2 markets per sector, there really has not been a lot of big trends to go by, except for maybe equities, as you rightly mentioned, Jerry. So I think that's one thing that's important. The other thing you mentioned about this period of underperformance, quote unquote, I was actually, I was listening to one of Meb Faber's, our coming guests episodes this morning as I was out walking, and I forget who the guest was, but they talk about, I think they were certainly talking about Buffett. So that was the topic of this conversation, and they too said, I mean, if you look at Buffett's track record, there are definitely long periods of time where he's underperforming, and where you could use the same argument saying, is that strategy broken? But it's actually the fact that you do go through these periods of underperformance that also allows the strategy to outperform over a long period of time. So they do go together. And I think actually for trend following, it's exactly the same. It's not a strategy designed to outperform year in and year out. And no strategy really is, in my mind.
Well, it reminds me of a study that I tweeted, I think, from Morningstar, and I've mentioned a few times on the podcast that a characteristic of managers who are in the top performers over a long 20 or 30-year period is they have a tendency to be the managers that have longer periods of underperformance. So in other words, if you want to design a good approach, make sure it has a larger number of periods that it underperforms. And so I think, I'm not sure exactly why that is. Maybe the harder it is to do, the more frustration it creates, and then that is going to make it a better approach or whatever. But looking at all the data is preferable and rewarding versus slicing it into smaller segments and trying to improve those periods where performance is not what you want it to be. But it is a sort of a perverse thing that you must desire long periods of underperformance. And I think that's a part of Buffett too. I think that in that same article, they said he could underperform almost longer than most other managers. So it's really crazy how it kind of works.
Yeah, no, I completely agree. It's very interesting. And I think you're right. I mean, I think that is probably why our strategy as a whole doesn't get the same positive accolades in many people's mind, because it is so hard to hold from time to time. So good. Yeah. Anything else from the world of Twitter?
Let's just throw in one of my favorite topics.
Sure.
The 200-day moving average. There was a couple of articles I read this week. One was talking about how it performs using the 200-day moving average on the S&P or stocks made more money, and it had lower drawdowns, of course. But there was one of my favorite articles here that in the same article, you have to just go read it. Maybe I am being unfair here, but it's the same article from a very high-profile person who probably doesn't like 200-day moving average or trend or whatever, but he says when bad things have happened, they intended to do so below the 200-day moving average. Of the 100 worst single days over the last 55 years, 83 of 100 happened while stocks were below the 200-day moving average. But then he goes on to say, there is no worthwhile system that will produce satisfactory results from buying above the 200-day moving average and then selling on a cross below. It's meaningless and randomness. Same author, same article. So anyways, you have to read it for yourself. You can easily find it.
Sure.
But and of course they sabotage the 200-day study by not including a short-term moving average crossover to limit the hundreds and hundreds of trades that it'll produce every other day. But it still works. They still can't kill it. They still can't say it doesn't work, even though they on purpose try to sabotage it.
Sure. Yeah. Sure. That's funny. Well, as I mentioned, we have a lot of questions, so why don't we just go straight to them and see how we go. First question is from Alfred. Alfred is a good friend of the podcast and very supportive, so thanks, Alfred, from your inputs and also for this question. So here goes. We know that all breakouts are not created equal. What are some of the filters that one might use to increase the reliability, accuracy of breakouts? I personally favor breakouts from consolidations and from low volatility areas. Any others? Thank you for your valuable insights. Moritz, any suggestions, any views on this question?
Sure. Good question. Thanks, Alfred. So I'm not using any filters The most important thing for me is to eventually get into the trade. If I don't get into the trade, then I have a problem. But getting into the trade, I think, is, I don't require any filters. I'm looking for new highs. If I see a new high, if the system detects a new high, then, I'll go long. There's no filtering, that requires a prior period of consolidation or low volatility or anything like that. It's pretty crude and raw at that point. I think your question on the consolidation and those type of things, I've seen this with volatility breakouts, which I think, Niels, you may be trading or doing that at Done. I don't do it. And, those are periods where, say you have a period of lower volatility or like lower ATR in the market, and then all of a sudden there's a big move in either direction, and then you position yourself in the direction of that move. There, I can see that filtering maybe to have more meaning. But as far as I'm concerned, with just looking for highs and lows, I don't use it.
That's true, Moritz. We do use volatility breakouts in one of our models, but we don't use filters either. I do know where you're going with your point, Alfred, that clearly if you can get in a low volatility environment, it allows you to generally get a bigger position on. And if you see a big breakout, obviously that's usually more profitable. Of course, the way we are impacted by higher volatility environments would be that generally our positions would be smaller at time of entry. But no, I mean, again, I think Moritz is right. I mean, you can sometimes add too many things. On the other hand, I know that people are, think of filtering. If you can get the right filters, that's kind of the holy grail of trend following. If you can filter out the bad trades to some degree, that would be great. We haven't found a way to do that either. And I think just doing the trades and being disciplined about that, is the most important part, as Moritz rightly said. Any views on your side, Jerry?
Yeah, I have a different view. I like what he said. They're good. Back in the day, internal trading filter was a bad word. It has a connotation that you're going to miss a trade. So that if you're going to have a filter, it can help a little bit, but it can't do but so much, because you eventually have to say, oops, I need to get in. And the filter has kept me out, and it usually works, and I like it. But I think that eventually you have to sort of throw the towel in and take a position. So, but I like it. I mean, one of the things, that sort of Rich made his fortune on was proving cliches wrong. And so I'm always listening for these cliches and these givens. This is a fact of life. And so one of the things that I know that you guys have said that I kind of take a different viewpoint on, subtly different, is exits are more important. So whenever I hear that, I'm like, no. I think entries are important. So I do want to work on my percentage of winning trades. I want to see if I can make it harder to get into a trend, not just by the breakout. So I like these ideas, but all of my filters are sort of speed it up, slow it down. If I have low vol or if I have consolidation, I'll get in quicker. If I don't have those things, I'll get in later. It needs to be a rule, and they do work, but there's nothing more important than getting into the trade and not missing a big trend. But I do think it's very important to try to improve your percentage of winning trades, which this sort of strategy can kind of help. And then I do think at some level, at some range of breakout parameters, they are all kind of the same. Too short term, no. Too long term, no. But there is a good area there where, I diversify my entries with different filter parameters and breakout parameters, but all those systems make about the same amount of money. So I do think that's, they all, to some degree, are kind of similar.
Yeah, I mean, I agree with that. I mean, I think, I guess my opinion about, exits being more important than entries, I think where I'm coming from with that is just mainly that I think a lot of trend following methodologies are able to spot the beginning of the trend more or less at the same time. And therefore, I don't necessarily know that. I mean, I agree with you completely. The most important thing is to take the trade. Absolutely. But I don't know that one method to another makes a huge difference when it comes to the entry, because I think trends or breakouts are relatively easy to spot one way or the other. Where I have seen some improvement in profitability is trying to get out at slightly better levels. But of course, you could argue the same, saying, is there a way to get in a slightly better level? Yeah, no, absolutely. Well, thanks for the question, Alfred. Great question. Now, the next question is from Walter. And he's got two questions. One is very short. The other one you can maybe elaborate a bit more on. So the first question was just if any of us are using volume as a signal in our systems. And the second question goes like this. Also, I've heard you mention several times that more volatile systems are more robust. I'm not sure if I completely understand why, and I don't think I completely agree. So, Jerry, do you want to hit that first and give your view on those 2 points? So volume, whether that's something you use, and 2, if you, and I think this, by the way, this comment about more volatile systems are better than, or more robust, comes from a paper written a long time ago by David Drews, I believe. That's where this comes from.
Sure. So I use volume just to choose the month I'm going to trade, and if I'm going to add the market to my portfolio. So I try to, when I set the portfolio up, I do it independent of a back test and only look at correlations and liquidity, and try to trade a lot of markets that are uncorrelated, or I weight them so they're the portfolio has more diversification, but lots of liquidity. And so I don't really combine breakouts and trend following with volume to enhance my signal generation in any way. But I think that the point, I remember that, and I've spoken about that paper on our podcast. But I don't remember, I remember the quote, and I don't remember Drew's explaining it very well. So I have created my own explanation, which is when you follow a system, it would have a tendency to be volatile if you follow it to the letter. And you can exercise some sort of discretionary or systematic money management overlay to just simply say it's too volatile, or I'm losing too much money, so I'm going to reduce positions, let's say, or take different positions. And I think that's the point, is that if you're following these rules, don't be surprised if it's very volatile and the drawdowns are larger. And then by the mere fact that you're only following the system rules, yes, it's more robust. And then traders who come in and limit that volatility and say, no, I cannot let the system do this to me. I'm going to, with a rule or with discretion, override the system in the name of risk control and risk management. I'm trying to be sarcastic here. Then they excuse themselves for not really following the rules of the system itself. I do think at certain points in time, you need to say, maybe once a year or once every other year, you need to sort of say, hey, I really do need to reduce my risk here. My volatility is too high. My drawdown is large. It's just doing across the board risk reduction, let's say. Far different than it being a daily part of your systematic approach that has a tendency to overwhelm the entry-exit signals.
Yeah. So the way I remember the article, again, this could be completely wrong, but the way I seem to recall his point was that the reason why more volatile systems tend to be more robust is the fact that they're not optimized, right? So if you start optimizing your system in order to remove volatility, kind of like a short vol strategy to some extent, if we use that as an example. So something that looks incredibly smooth and kind of enjoys stability of markets in order to create the returns, but where the when the problems happen, they happen big time, and sometimes these strategies completely lose everything, or at least have severe drawdowns, right? So this kind of short vol profile, like we probably are all aware of. So my interpretation of the article was really that the fact that trend follows, we're not trying to remove volatility per se. We're just taking the signals as we get them. And in that sense, if you do it, at least the way we do it, we're not trying to be too clever and too optimized. Well, that generally produces more volatility in our returns, but it's actually, or at least the way I remember the article, it's actually also the reason why these strategies have been around for such a long time, because they are able to cope with these different market regimes that we get from time to time. So that's how I would interpret the article, Walter. What about you, Moritz? Are you familiar with this, or have you got a different view on the whole concept?
I think everybody would like to reduce volatility, myself included. It's just, as a trend following trader, the edge that we have and that we aim to extract from the market doesn't lend itself to a volatility reduction. I mean, you could do that, by throwing many more parameters and variables into your trend following trading system with a good back test, but forward looking, it's not going to work. So we just have to embrace that volatility, accept it for what it is, because we must not overfit that system for past performance and try to smooth it too much. I think it's a result of pretty much all trading strategies that if you want to have them for the long run and build that very long track record without blowing up, volatility is part of the equation. And one of the things that you have to come to terms with, because it does produce the robustness and it allows you to stay in the game for years and years and years. If you make it too smooth, and the risk goes somewhere. You may not see the risk then on a day-to-day basis, but all of a sudden it will show up, and it will show up in such a big way that maybe you cannot trade the next day. So that's the way I see it. I need to accept the periods of drawdown. I need to accept the volatility. For trend following, I don't see any other way. So that's that. On the volume, exactly, pretty much, like Jerry said, I mean, I'm looking at volume to find markets which can be traded and added to the system. And I look at volume to determine when to roll over markets. But I kind of I have a rollover schedule, which I fix. And then, so say I'm rolling 2 days prior to the last trade days, or, 10 days prior to first notice, or something like that, right? And then I just keep it that way. So I don't revisit volume all too often, to be honest.
Yeah.
I agree with, and I think I was trying to say the same thing that you guys were saying, but you did it so much better. I really like the way you said it, Niels. But I would just add that the way I would look at it is exactly the way you guys described it, but it's more like, am I looking at the trade stats? Where's this system that I've created with these rules? My average win is X, my average loss is something else, my average my win percentage is that, and then my win-loss ratio. And so I'm totaling up what I call these trade stats that are irrespective of the equity curve. And I think that's where the trouble becomes, when once you're done and you look at this historical performance, you're like, wow, that just can get pretty volatile. Now, let's set our sights on reducing that volatility by coming up with rules that are going to make the equity stats, the drawdown and the returns look a little bit better. And I think that's where it starts to go off. If you're trying to, after coming up with a few entry and exit and a stop loss, going back and analyzing the performance data, I think that's where you want to make it less volatile. That's where the rules get a little more sketchy.
Yeah, no, I agree with that completely, Jerry. And I would add one more thing, and I think that you touched on more, which I heard Chris Cole talk about in an interview, and I think it's absolutely true. And that is, you can't remove risk. You can push it into the future, but you can't remove it. And I think that's something that people, I mean, there may be people who say, of course, we can remove risk, but I'm not so sure you can. And one of the things that I've always felt was kind of funny about our industry and people's expectation to the industry, and that is when you look at the markets we trade, they are inherently volatile. I mean, just look at what happened this week. I mean, some markets were up almost 10%, other markets were down 5%, right? So I've always felt it was funny that people had the expectation that trend followers had this magical formula where you could take inherently volatile markets and then just remove the volatility and be left with all the good stuff. I mean, that's not how it works. Now, some strategies claim they can do it, and you look at these equity curves, and they're incredibly smooth. I'm just not so sure that would last for 50 years or 40 years, as we've seen in the trend following space.
Yeah, this is another thing I like to talk about a lot, but I do think, I think you guys agree that diversification removes risk. It is the only thing
Sure.
that we can add,
Yes.
and we so need it. I think that I think we had a question last week where I sort of downplayed this, but I believe that a systematic approach with a 40, less than 50% win rate that relies on mega trends that are infrequent, and maybe 5 or 10% of our winning trades pay for all the losses and create the profit. It needs diversification more than anything, shorts as well. So, and that's why I've been on a 30-year hunt for more diversification in single stocks, and looking at volume and open interest to try to add more and more markets that were less correlated. And to some degree, when we do this back test, we see the power of this diversification. If we only trend followed stocks or currencies, we would have this 8% return with a 50+% drawdown as well. But as you kind of start adding these sectors to the portfolio, you see, that of course the performance doesn't fall off. All the trend following trades have the same expectation, but the risk starts getting lower and lower as you add these markets and sectors and shorts. But we have it's kind of a problem because we look at all the data, and one of the problems with looking at all the data is we're not focused so much on living through some bad periods historically. We say to ourselves, oh, that would have been great. I would not have had a problem with that drawdown in those past years, because now look, it averaged 10% a year or 15% a year. But living through those, and with something like trading stocks only, they're sort of always correlated. So you know what you're getting into. It's going to have these crazy returns and crazy crashes, and it's no surprise. And the possibilities are within more of a range. But we kind of we forget sometimes that even with a diversified portfolio like ours, the correlations can go to 1, and we're so levered up, and we have so many different markets on, relying upon the diversification, we can get crushed sometimes when that diversification kind of goes away.
Absolutely. I mean, I think you bring up a really important point, and it's a point I think unfortunately is lost a little bit when you see a lot of people who wants to talk about trend following or even write books about trend following. It's often, in my view, ends up being something that can be interpreted as, oh, but trend following works, and therefore I can just do it on stocks, or I can just do it on bonds or whatever. And so this is my concern. My concern is that a lot of what is easily available in terms of trend following 101 kind information, it leaves out the importance of diversification. Because what Jerry just said is so true. Trend following without diversification can be lethal, in my opinion, because if you're just trading say stocks, you're going to have a completely different drawdown profile than the profile that Jerry has in his portfolio. We have, Moritz has. So this is why I sometimes take a little bit of an issue with some of the material that is out there because they forget this point. And once you add diversification, it also takes out a lot of people's ability to do it, because you can't. I know there's a question coming up later today, or maybe we'll kick that to next week. But there is a question coming up about how much can I trade? How much should I trade in order to do trend following well? And so a lot of people say, well, maybe I can start with $10,000 or $20,000, et cetera, et cetera. But in my mind, unfortunately, that is not doable. And therefore, often, and it's certainly not in any self-serving interest that I say this, but very often, most people are better off finding a manager or two where they can make an investment of 100,000 or 50,000 or whatever it might be, and get the exposure to trend following there, and continue to educate until they have a size of their portfolio that is big enough to do their own, even though that may be what they really want. I don't think it's always a good idea to start out doing trend following on your own. Anyway, thank you very much for those comments, and thanks for the question. I've got a question here. I'm going to do my best to distill it down. It's from Paul. Thank you, Paul, for your question. It's about an article, so we can't go into the actual article per se, Paul. So I'm going to try and just ask the questions so that everybody understands what it's about. And Paul writes, it seems to let me start that again. So it's the idea and the approach about big data may help with sorry, let me just start from scratch here. It's an article about that criticizes algorithmic trading, but it also includes kind of references to trend following, et cetera, et cetera. And so it goes on to talk about, how big data will help this sort of trading, but that, and then now I'm going to quote the question, but that this increases unpredictability of markets, which is a brush that trend followers are frequently tarred with. However, I don't see them as the same. Trend followers do not predict the market, and the only data they are concerned about is the price. Several times in the article, they talk about the algorithmic predictions of the markets, and it seems to me that this is the central flaw of their technique, which leads to the unpredictability they lament. Sorry about Paul. This is not a great way to do justice to your question, but it's a little bit hard the way it was written for me to distill it down. I think what the question is all about is that often we see articles where it's all mingled together: algorithmic trading, trend following, big data, and then they start talking about words as predictability of markets and how these strategies makes the markets more unpredictable, and with flash crashes and so on and so forth. I think that's where you're going, Paul. And anyways, let me start out with just giving my 2 cents. And I mean, I think you're absolutely right. I mean, there is no predictability in what we do. We are reactional in our trading methodology. We just react to price with a predefined set of rules. So a lot of this criticism that we often see in the news, I think, is confused with other types of, systematic type trading. And where maybe there is, where they are trying to predict what's going to happen in the next 5 minutes or the next 2 hours, et cetera, et cetera. But that is not really, I think, what pure or true trend following is about. Jerry, Moritz, feel free to help me out here. I think I did send you this question, but so maybe you have a better answer than I did.
Yeah. Well, I'm not sure if I have a better answer, but you're absolutely right. I mean, I don't have the capability to predict anything. So neither does my trend following trading system predict anything. I don't know what markets are going to be doing tomorrow on Monday, nor do I know what they will be doing on Tuesday or Wednesday. Everything could happen. And so, this just not relates to me. We spoke earlier on this podcast about people they like, or investors they like the new thing, and the grass is greener somewhere else, and somebody comes up with a new mousetrap, and then the focus is on that. Maybe this is now big data and machine learning and all that, which which I've said it repeatedly, I'm not smart enough to even wrap my head around. I'm not sure how to work with that. I'm curious to see what comes out of that, to see the first, real track records based on pure AI and how good they really are. And, the person that has the capability of predicting the market and knowing what tomorrow is going to bring, we're probably not going to meet that person because he or she will just do that for himself or herself with their own money and probably not share that with anybody. So I don't know. I take the role of an observer with all the people that claim to do it in a better way and to know what tomorrow brings and predicting markets with big data. Just not my cup of tea, but we'll see what the next years bring.
This was a great article that Paul sent to us, and I do, and I sent you guys, and I tweeted this. This is the tweet that I mentioned on the air a few minutes ago. But I took away from this article something entirely different. It was about the stories, and stories aren't robust. Management fees are large, and your desire to sort of sustain a story so you can keep your AUM high. But what I took away from this was, this is like the best reason I've heard for charging a healthy incentive fee and maybe no management fee, because you're sort of saying to clients, you're paying for performance. I don't have a story. Pay no attention to any story. I must perform for you, as I will have no other income from fees based on my AUM, and I have no incentive to do anything that will only increase my AUM. So I really, this was like a revelation to me, that because I've never been that keen on zero management fee and a big incentive fee or that type of idea. But this really, if this drives home the point that I'm not going to make money off of AUM and tweak my system to keep your money around, I think that's a pretty powerful message. So I like the article, but getting back to the question and on topic, I would say that even though all of that of what you said is true, too many people with trading too many trend following systems in markets that are not always liquid can create lots of problems, crashes, and the fall targeting can kind of overwhelm markets and make them sort of crash, create chaos. So we're not immune. If there's too many wonderful trend followers out there, we can kind of mess up the trends.
Sure. Well, thanks for that, Jerry. That's good that you had a more detailed response, I think, to the article. Next question is from Robert. Robert has asked us questions before, so great, Robert, for you to be back with more here. This is probably mainly for you, Jerry, because it's about single stock futures or trend following on single stocks. So here goes. As to single stock trend following that is often discussed on the podcast, are these instruments being traded in the context of CTA funds by means of regulated exchange futures products? ? If so, can you provide some more information on what, where, and how these instruments are traded? Lastly, do Jerry and others find these markets liquid enough to transact at the size that they want to trade? I have a few brokerage accounts where I can trade futures, and I have never run across single stock futures. However, this podcast has piqued my interest. I have no good information to share on that, Jerry, so I'm going to pass it on to you.
Sure. So there are single stock future exchanges that we utilize in the U.S., and I think there is one or so in Europe as well that European CTAs probably access. I think that's no really difference between trading a cash equity or a single stock future in the same market. And it's just one of how, if you need leverage, you can access it in a cash by borrowing money from your broker, or you can access the single stock futures, which I think give you like 5-to-1 leverage. So, and then like a lot of markets in the currencies, especially, you can kind of do the trade in a cash market and your broker can turn it into a future, so you can access the liquidity of the cash if the liquidity of the single stock is not what you needed to be at that point in time. And we trade, once again, the largest stocks. And so we're always making sure we have plenty of liquidity. But it is a good tool, easy to go short. Shorts can't be called away, so it has some advantages.
Great. The next question is actually along the same line. It's from Chris. And Chris, thanks so much for your question. So let's stay with that. Chris goes, why is individual stock trend following so absent from investment management and trend following talk overall, both by individuals and firms like all of you run? I wouldn't say that Jerry's not it's not that it's absent from Jerry's approach. But anyways, I used it myself, and when I was considering, there was so little data on the proposal that I was worried. I was worried I was making a big mistake. Any thoughts on both why this is true, and one of you the only, and let me go again on this one. Any thoughts on both why this is true, and are you one of the only investors using individual stocks? That's question number one. Question number two is trading frequency. In the analysis I performed, it appears that more frequent trading isn't always the answer to long-term success. Are all of you daily traders where you take a position immediately after the signal, or is it calendar-based, i.e. end of week? And final question is about stop losses. Without giving away your secrets, how do you think about stop losses in a portfolio? Do you use them, or are you simply waiting for trends to break before exiting? So 3 questions from Chris. Moritz, do you want to kick it off? Even though the stock, individual stocks, I'm sure Jerry has more thoughts on that than we have.
I start from the back. I think the last question was about the stop losses and whether we're using stop losses without giving away any of those secrets. So the very short answer there is yes, absolutely. Stop losses are extremely important. Every time a trade is entered into, a stop loss is assigned to that trade and to that position. So it's very important to have that stop loss kind of like set up and, included in your system so that you can keep your losers small and get out of them if they don't work. That's extremely important for trend following. So yes, stop losses. That's an easy one. Trading frequency, I think, was the second question. Yes. Whether if there is a signal, you get in right after the signal, or whether there's a delay and it's more calendar based, maybe kind of like end of the week, end of the month type of things. There are systems that work on that basis where, they are longer term. They only, take positions at the end of the month, if the environment has changed. I cannot say that those are bad systems or that they do not perform. I'm sure many of those do perform. But as far as my personal trading is concerned, I do get a signal and then I want to get in. So there is no, of course there is a delay. I'm not getting in exactly with that signal, but there's not going to be like, a day or two or a week or something like that in between. If the signal is there, then that, is a call to action. So the first question I think was about the individual stock trend following. And, I don't see any good reason as to why single stocks should not be included. In fact, I'd like to include it. It's oftentimes a question of mandate, whether, investors or whoever you're trading money for sees that as a part of the system. I have the feeling that sometimes investors, they don't really see it, and they kind of like people to, or their CTAs to stay with, the futures markets and the equity index markets and not go down the single stock route. I'm not saying that makes any sense, but it's one of the reasons why it's absent from my portfolio at that point in time. If it weren't for that, I'd be probably diving right into it next week, and I'll do it.
Great stuff. Jerry, do you want to dive into the same questions?
Let's see here. I'm older than you guys, so I'm going to struggle to remember them. Stop losses are great. I'm all for them. Not too close to the market, not too far away. You got to find that sweet spot where your winning win percentage is not in the 20s, let's say. My opinion, I think I've read where there's lots of people who enjoy 20 and 30% win percentages, and then not too far away to where it's not really much of a small loss anymore. What were the other questions?
Oh, yeah. So the next question was about trade frequency. Do you jump in after the signal, or do you wait? Do you have a delay? And then the final question was about your general thought. I mean, our general thoughts on why we think there are not so many people doing trend following on individual stocks.
Oh, yeah, I would just jump right in. Especially, I would follow the system as closely as you can. If you're buying on the close or buying intraday or buying on the open, and that's the way you've done your back test, and that's your system, then I would just go ahead and do that. You're playing probabilities of the system working. Why introduce some sort of random way of waiting, hopefully that you don't have to do the trade or you'll get a better price. That I've tried that, and I stopped it once I started keeping records of how it was hurting my performance. It's sort of like anything that you try to do using common sense, quote unquote, that's different from the system, that your rules, that's not going to work for you. Although I definitely would change my system a tad to sort of say, for instance, if the 50-day breakout I think is a good place to buy, maybe I would say, let's wait for it to go through there. And our rule would be it has to close above that a little bit, or an amount that, so we don't maybe buy some false breakouts. If we think that's a good idea, then, but once you've got the rule, go ahead and do the trade.
Absolutely. So, Chris, just my 2 cents on this. We do things a little bit different. So I'm not opposed to stop loss. I think for many people, it makes perfect sense. But at our shop, we look at the portfolio a little bit from more of a statistical approach, meaning we don't look at it as a trade by trade kind of system. We look at the overall exposure we want to a market based on the individual or underlying signals that we get. So we don't actually use stop loss in our approach, but we would wait until we get a new or change in signal strength in order to either increase or decrease our exposure. And then, of course, once the signal strength goes from, say, positive, meaning long, to negative, meaning short, that's when we would essentially, flip the direction of our position. But it's a slightly different approach, but I certainly agree with what Jerry and Moritz shared about stop loss is super important. But there are obviously different ways to do that. Trade frequency, we adjust our positions every day based on the changes of the signal strength. So we don't delay it either. And I have no real view on the individual stock trend following. I think Jerry is the expert on that. I will say, though, from just my limited knowledge about this, is that I think it is true that there is not a lot of discussion about this. And I think Jerry is one of the more vocal on this topic. And maybe it's because it's a little bit harder to do, at least perceived to be a little bit harder to do than just trade the indices on a futures exchange. And maybe that's why that, fewer people are doing it. But, kudos to those who do.
I would just, Moritz said something that was very interesting, and the mandate. Yes, I think that, this is something I've railed about as well, and that let's change the mandate. I mean, not don't fire all your clients and stuff, but it seems like over time we do need to tilt more towards diversification, the perfect portfolio, which would include more diversification on stocks, bonds, currencies, commodities. Keep adding those markets to your portfolio, and don't trade the dollar index, don't trade a commodity index, don't trade stock index unless you have to. But I do think the mandate we need to tilt more towards the perfect portfolio versus the perfect hedge. So let's go from being qualified and to manage most of the portfolio, because it's systematics rules, there's risk control, it's lots of diversification versus managing 5 to 10% of the portfolio. Let's, over the next 20 or 30 years, after I'm long gone, let's hope that the industry, the CTAs, get more AUM and more of the portfolio, and what we do and how we do it is recognized as something that's worthy of a majority of the assets, and maybe 10 or 15% is allocated to passive stock long only, versus what's happening now. So I do think that's a real world concern that most of your clients, I had a large client once and I went to them and long time ago, 90s, and I said, can I trade stocks in your account? And they said, no, you're a futures trader. Then a few years later, single stock futures came out and I said, can I trade single stock futures? They said, yeah, you're a futures trader. So we're in that's silly, right? It's just a financing mechanism. Do you need financing? How are you going to get it? It has nothing to do with the underlying asset. They're the same. So, but, we get pigeonholed in these boxes and we just need to get out of the box. And when it makes sense, rhetorically, always, but practically speaking, you need to take care of your clients and give them what they expect.
Such a great segue to the next question, actually. This next question comes from Matt. Matt and I had an offline conversation. Matt is from this industry, I should say, and used to work for a competitor of ours, so to speak. But he's now working more on creating that product that you were just referring to, Jerry, in some ways at least, but creating a product where essentially trend following would be a big part of it, and maybe not exactly how you were describing it. I think in this case, Matt wants it to be 50% trend following and 50% S&P, and if you combine those two approaches, there is all the evidence goes towards that this will perform better than just a pure equity portfolio. Anyways, it was just to frame the question. And so the question really is, it's more maybe a philosophical question, but he says, picture a world where investors were comfortable and confident rebalancing into drawdowns, not concerned about fees or moving parts inside the CTA allocation, say 30% of their wealth to CTAs. And he goes on to ask, what do you guys think needs to happen to get to that? So it's also kind of where you're trying to take the discussion, Jerry. I mean, what needs to happen for people to embrace either trend combined with passive, long only, but in a much bigger way than we see today, or as maybe you are referring to, trend as the overall strategy and just taking long and shorts from all of these asset classes. What needs to happen?
I think we're seeing the beginning. Trading single stock futures is important. Some of the larger managers having good performance and saying some of it's due to that would be helpful. Then we're seeing mutual funds and come out that are CTA managed futures portfolios plus permanent longs in the S&P or other indices. So there is this sort of recognition that let's create programs that are sort of one-stop shopping. You don't have to think about how much alternative or CTA you want and how much stock you want. I'll create it for you. All you have to do is just invest. And so I think that's probably the beginning. But I think just the mindset of, look, we're very happy to be 5 or 10% of your portfolio. Don't get me wrong, but you have to start advocating for yourself that you deserve more. The fees are going to be important. The volatility is important. Is anyone out there trying to make 8% with less than a 50% drawdown? We've talked about that. I doubt it. Probably every CTA, almost everyone, their goal is a lot more than 8%. So that's a mistake if you want to be seen as a place for people to liquidate some of their stocks and come into your fund. They're not missing out on stocks. We'll have a healthy amount of stocks, a lot of stocks, mostly stocks, or whatever that agreement is with your client. but I don't think it's difficult for people to see, especially maybe it will take a large drawdown in equities to see how important of it is that for us to really add out crisis alpha, we need to trend follow your stocks as well.
Yeah. Moritz, any thoughts on your side or?
Well, what can I add? I think it's important for pretty much everyone in the markets. That includes us. It includes investors to see the long-term benefits of what it is that we do. I mean, my feel is that a lot of investors they want that instant gratification. They want a strategy that is there all the time, hedging all the time, making money all the time, not letting them down, avoiding the drawdown, avoiding the pain, all of that. And then you mix it up with maybe the advice large investors get from their consultants, where the consultants may impact the decision and they change every year. And now there's been a year of underperformance in the CTA space, and that means you must get out of CTAs because those guys aren't delivering anymore, and we need to go back into commodities, long shorts. That I don't know. None of that really helps, I believe. It's important to see that long-term benefit year over year over year. And if you have that view, if you have that mindset of, looking at that for 5, 6, 7, 10 years, something like that, it's very difficult to get around trend following. You'll when you look at that within that time scale, you'll probably see that this is the thing you really want to have in your portfolio with a much, much greater weight. And so I think that needs to happen. And maybe we need to say that over and over again and reiterate it on that podcast and, in other places, that this instant gratification thing, short-term trading, getting things smooth and right without a drawdown, that's a problem. I think people, they damage themselves with that mindset.
Sure. I mean, I would add two things to this point. From my conversation offline with Matt, he made a great point, and I think that's actually along the lines with what Jerry is suggesting, and that is what we as an industry are dealing with is kind of a twofold problem. One is that we need to make the argument that adding trend following to your portfolio is the prudent thing to do. But the other thing is that it also needs to be the practical thing to do. So instead of just being prudent, it needs to be prudent and practical. And so creating products that are easy for people, for investors to buy, that combines these things makes a lot of sense. And I know that's what Matt is working on. So I think that's a great, it's a great thing to hopefully solve for our industry. The other thing I want to mention, I was just reminded from back in the day when I was working for Jerry. I had another colleague called Tom, and Tom always made the point that if ever anyone could, come up with some proof, come up with some white paper that would essentially argue against the old Lindner discovery and paper about how adding managed futures or trend following to a portfolio of stocks and bonds, that helps, increases the returns, reduces the drawdowns. If anyone could ever come up with a white paper arguing the opposite, he would be very interested in seeing that. And of course, I'm sure he's never received anyone sending him because it doesn't exist. And I think the important part here is that a lot of investors really do have a fiduciary responsibility to their stakeholders. And so we also need to consider, or they should at least consider, why they shouldn't allocate a larger proportion of their portfolio to these strategies, because all the evidence, and it goes back to, I think, a tweet that Jerry, you shared a few months back or a few weeks back about, being an evidence investor or evidence-based investor. I think maybe it was Meb Faber who originally had sent it out, and you retweeted it. Where is the evidence for not including this to a much larger degree than what we see? So there's just some of my thoughts on that. We have a question from South Africa. Peter Francois has sent us a question. This is more of a trader's question, so to speak, or someone from someone maybe involved in trend following, doing it himself. So it's more of a technical question in some ways. It goes like this: if you are running a trend following fund and you have 10 positions open, with all of them starting at 3 ATR initial stop loss, and each one size was calculated based on equity at that point, but now you suddenly get a big influx of new investments from new investors. This will This will increase the fund's equity. Will you buy some more of the 10 trades to reflect the increase in equity? I'm not thinking of this as vol targeting, but rather staying in step with your leverage or your level of equity as it changes due to investor deposits or withdrawals. So that's question number one. For some of these trades, price might have moved up very far without the stop loss having moved up yet. So if you buy more of the markets now, where will the new stop loss be? At the same place as the original trade, which will be much further away than the standard 3 ATR, or also at the system 3 ATR stop loss level? So a bit more of a technical question. How do you deal with changes in equity if you have open trades, et cetera, et cetera? What are your thoughts on this from your experience?
Yeah. So thanks for the question, Peter Francois. So this is about the subscriptions and the redemptions if you run a fund. I don't count those as trades. They're not signals or trades generated by my system. I can't influence them. They just happen as and when they happen. It's really completely random. So they're not trades in that regard. And yes, so if they come in, or if there is a redemption, then proportionally, I will adjust the positions of the portfolio up or down, as the case may be. And so let me try to give an example maybe that makes this a bit clearer. Say you run a 10 million fund, right? And then one day you get a 90 million subscription. So now you run a 100 million fund. And say you had this like super stable system, which doesn't do anything for the next 3 or 4 months, then you would essentially have 100 million and have positions on for the next couple of months that only reflect a size of 10 million. So clearly that's not the fund you want to run, and your investors expect something else as well. So you kind of like have to go in and up the trades, up the positions in proportion to the new account size or the new fund size.
Yeah, Jerry?
I think that's right. I think clients expect to get your fund's performance after they're in. They know that everybody else is up 20% and there's a lot of open profits. So, but I think it's just clearer and probably okay to, from there on, and once you, sort of like if you invest in an S&P fund and it's up 20% for the year, you want that you're expecting the manager to put your investment to work, and to you'll get the return from that particular day. I would encourage clients, if that's going to bother them, or if they ask my opinion, and I would say, oh yeah, I'm up 20. We have lots of open trade equity. It's going to fluctuate a lot. These people, when the markets go down, I'm not taking a small loss anymore. I'm going to allow those drawdowns to be larger than my small losses, my stop losses. If this bothers you, put in 5 million each month for the next 4 or 5 months, so you can sort of get a more smooth return.
Yeah, no, absolutely. I mean, I agree with both of you. I mean, I think you have to just adjust your equity as it comes, because it doesn't change the risk. And, you need to always reflect the performance that would have been for, if you had not received any influx of capital, and therefore the positions are the positions. And if you get more capital, you adjust the size accordingly. So I completely agree with that. So thanks for the question, all the way from South Africa. Next question is from Francois. And I'm not entirely sure, Francois, whether you are a little bit cheeky here, but let's see what Jerry and Moritz think about the question. He says, "Hey guys, what is your take on factor investing, such as value and momentum?" And here's the cheeky part, which I'm not sure whether that's we'll see. Is it possible that all factors are superseded by a super factor called by the breakout factor? So I'm not so sure what that really means. But anyways, any views on factors? Have you done a lot of work other than on the factor that we tend to operate within, namely momentum?
I've looked at them, and yes, I mean, I love momentum, trend following, which is time series momentum. That I think is it's the best to me. It's the one that I want to work with. That doesn't mean that, value doesn't work. Just, when I make the comparison between my diversified trend following trading system and a value strategy, my conclusion is that I want to stick to my trend following trading system and not to the value strategy. As to all the other factors, one little anecdote. I had a conversation just this past week, I think 2 or 3 days ago, with a fund manager, and this is on the back of the Miami conversations,
Okay.
Niels and Jerry. So there seems to be this inflation of factors. I mean, we know the Fama French 3-factor, 4-factor, 5-factor, and you have those factors like value, growth, momentum, all those type of things, which books have been written about them, and they've kind of they have an empirical basis, if you will. And then I hear, well, we're looking at more than 1,000 factors. And I said, what is that? I mean, what is 1,000 factors? Like, do you really mean like factors? And which one am I missing? I said, yeah, there's 1,000 factors, and they give them crazy names. But I'm completely lost with that. I don't know about 1,000 factors. I mean, we can come up with 1,000 statistics and signals and those type of things, but I wouldn't call them a factor. So, well, that's off a tangent here, but like I said, I like the trend following and momentum stuff. Don't want to discredit all the others, but if I make the comparison, trend following, time series momentum comes out ahead for me.
What say you, Jerry? Yeah.
Of course, I had a article that I tweeted this week. I should have led with this, and it's a study from some academic types, I guess. And the quote was, the momentum factor is prone to crashes, has a negative skew, and is a relatively short-lived signal, implying high turnover and high transaction cost. And I end it by saying, not so for trend following time series momentum. So it's important to distinguish between the academic version of the momentum factor, which is cross-sectional momentum. Typically, you look at the top 10% performing stocks over the last year. You go long those, then you see the 10% that are the worst performing stocks over the past 12 months, and you go short those. And so that's when academics got a hold of momentum and trend. This is what they came up with. I don't think it's robust to base signals on what other markets are doing. Dual momentum is a term that I've heard as well. That's came out of, I think, 2008, where as the market is crashing and you're continuing to rebalance these stocks and you have longs and shorts, the need arose to sort of say, why don't we make sure that our 10% that we're long are in an uptrend? So they have to rehabilitate and to save cross-sectional, they have to add time series to it. So we throw these terms around, and we don't really always know what other people mean by them. But I think according to this study, the momentum factor is more of a cross-sectional versus a time series. So we're all fans of the time series, trend following, not so much the cross-sectional.
I mean, from my point of view, I just want to go back, I don't know, maybe 10 years. Nobody were talking about factors. I mean, it didn't exist. If you spoke to anyone in the banking sector and they said you did trend following, they would just shake your head or shake their head and look at you as if you were doing something completely alien, and not very not very fond of this strategy at all. And nowadays completely different, because these same institutions have found a way to package products by using the name factor, and suddenly they can do trend following as well. They just call it a factor, a momentum factor. So I'm not a big huge fan of this change of terminology. I think it's something that has been done purely for kind of marketing purposes in some ways. But I do recognize that there are a couple of factors that are that are important and that have been around for a long time, but they weren't really talked about as factors like trend following wasn't. And of course, one of them being value. I mean, value has been around for a long time. But it wasn't really talked about as being a factor. So I think this factor thing is just something that has come in recent years, and mainly being promoted by people who a few years back didn't really like trend following, but now if they call it a momentum factor, they're perfectly fine. In fact, they're very good at it. They've never done it before, but now they're suddenly experts in doing it, and it's such an easy factor in their mind that they can sell it for almost nothing to their clients. So, as I'm sure you can tell, I'm not a big fan of the people who came up with these kind of ways of selling or packaging these things. Now, we have one more question left, which I think we can deal with pretty quickly. But I wanted to bring something up, which is a little bit related to this point about the factor. It was an article I came across in Forbes this week, and it goes to show, I think, this a little bit about how the press. This is maybe a little bit harsh to say, but maybe there is definitely this tendency of trying to label things in certain boxes. And it's an article about equity trading. And it talks about how JP Morgan now estimates that 90%, 90, of current equity trading volume today comes from quote unquote trend following traders. And I'm just thinking, what? I mean, trend following as the industry that we're in is not a very big industry. So suddenly for us as trend followers to make up 90% of the volume, I think it's completely inaccurate. Now, I do know where they're going with it, because they're putting everything quant related into the bucket of trend following. And that's how they come up with this. And they go on to say that that now we've only got 10% left of people who are fundamental active traders. And I'm also thinking, well, why do you think that trend followers are not active traders? I think we are. So I think it goes to this point about or the danger, and this actually comes in an article where it's headed, a warning from the late John Bogle, who of course is the inventor, or at least credited as the inventor of passive investing through his company Vanguard. And it's this thing about the passive funds and their flows are so huge that they do probably make up a substantial part of the daily volume, in particular in equities. But these volumes, even though they might be executed systematically, in my opinion, should not be confused with trend following and what we do. But unfortunately, there seems to be a tendency that this is happening, and then people get the wrong impression about what we do, and also the role we play, because clearly when there are flows from these huge passive funds, especially if it's outflows and therefore selling pressure, then it can lead to very large market moves. And then that is often then related to, but it's all the trend followers selling, that they're the ones causing the markets to drop. But I think any of our strategies that we represent, and many of our peers, we don't even participate with large volume at the times when these crises happen, because our positions are already put on by that time. So I don't know if any of you saw that article, but it's just one of those things where, again, we're being labeled in somewhat of a negative light.
I think I saw it. I took a different, had a different takeaway. I think that I could see how it's the ultimate compliment, where people are buying into it. They're like, oh, I like these small losses and going with the trend. So what do we do with that? I don't think they're systematic traders necessarily, but are people taking elements of what we do, the small losses and the trend, and paying attention to price and getting out when the markets are crashing, or getting in when they're rallying, and timing their entries and exits, even if it's a fundamental viewpoint. Maybe they're not systematic trend followers. So I don't know. What do we do with that? It's kind of great that, what are we doing on this podcast but trying to get people to invest and agree that this is the only prudent way to do it. And now that people are doing it, we shouldn't be surprised. How long do they hold it? Yeah, I don't think that we're 90% long-term trend following is 90% of anything, but some of the elements of our approach should be used by others, and it probably is.
I agree with that point completely, Jerry. If that was the case, I think that what I took away from this article was more the fact that we have this growth of passive funds now, that they're making up this huge amount of money flow now, and of course they are, their volume, I'm sure, could get to very high percentages. My point was just that I think people are confusing these passive funds and their quote unquote systematic type trading in the markets as being trend following, because I don't think it is. But you're right. If other investors are using some of the trend following philosophy in their approach, great. That's what we're trying to get people to do. This question is from Alex, and it relates a little bit back to something we talked about earlier about sort of diversification and size, et cetera. And Alex goes on, my retail traders will start trading with a small pool of capital. What would the panel's different approaches be to trading $20,000 versus $20 million in a trading account? Different instruments, presumably futures, would not be viable with a small account of capital. Do you even think trend following trading is worthwhile, trading relatively small amounts of capital? So, Moritz, what do you think?
Yeah. So with the 20,000, I just, coming back to what you said, Niels, earlier, is you're much better off, I think, putting the 20,000 into a fund, or maybe two funds, 10,000 and 10,000, and get a bit of a diversification. But you'll find it very difficult to trade a diversified trend following strategy with a $20,000 account, just because of margin requirements, the number of instruments that you can trade. It isn't going to be that much. And say if you only, say you put $500 into each position to get more positions, then your commissions are going to be too high compared to, the amount of money you trade. So I don't think that's a good idea to start. So probably better off to do it with a fund and get the experience, learn, observe, and grow the account to a larger size, and then develop your own trend following trading system.
Yeah,
I agree with all of that. I think if you have a young person who you are trying to teach some good principles of trading and trend, and putting a small account in a discount broker and introducing them into charts and stocks, stocks only, and then breakouts and risk control and the spreadsheets that go along with the size of your positions. And it's a pretty good idea. It's a kind of a training tool, better maybe than paper trading. So I did that for my son, and he, to give him some experience. You're just trading stocks, but it's not practical to really get into a CTA type situation with small amount of money.
Sure. No, I completely agree with Jerry and Moritz on this one. Alex, I do think, to answer part of your question, I do think there are maybe instruments like CFDs where you can start or maybe get some level of diversification, because these can be tailored to smaller notional value than futures. But I'm not an expert in that, and they're not exchange backed. And one of the mantras of the CTA world is, of course, we like the fact that there is no, or at least a minimum amount of counterparty risk, and that's why we like exchange traded futures, et cetera, et cetera. So, but generally speaking, there's nothing wrong with studying and following and doing your own quote unquote trend following, at least on paper, with as long as you have a small account. But if you're purely looking for the best return, as long as you are a small investor, maybe it's the best idea to find an experienced fund manager who offers access without charging too high fees. And luckily, with the last 4, 5, 6 years, there are mutual funds in the US, 40 Act funds. There are usage funds in Europe that allows investors to participate. Unlike in the old days where you had to be, quote unquote, a qualified investor before you could even receive the subscription documents. Luckily, we are past those days now. But thanks for the question. Thanks for the questions to all of you who wrote into us. And remember, next week we have a guest, Moritz Seibert. And, if you have some questions for him, please do send them into info@toptradersunplugged.com. Let me just run down while you, Jerry, and Moritz can think about anything else you want to bring up. But let me just run down the performance so far of the industry. These are as of Thursday. And frankly, I don't really know from what Moritz said earlier in the podcast about having a great week and we on our side not having such a great week. I don't know if Friday was a good day or a bad day for the industry as a whole. But here goes anyways, because these numbers are of Thursday evening. The Beta 50 index is up 0.43 for the month and down 1.34 for the year. SocGen CTA index up close to 1% for the month, down a little bit less than 1% for the year. SocGen Trend Index up 1.41% for the month, down 1.81% for the year. And the SocGen Short-Term Traders Index down 0.5% for the month and down 2.2% for the year. And finally, the Bridge Alternatives, the Flat Fee Index, up 0.88% for the month and down 3.21% for the year. Great questions, guys, this week. Very different types of questions. Anything you've thought about that you want to bring up before we wrap up?
No, I think we're good. Have a good week, everyone.
Yes, I need to come up with my sign-off slogan that's become so popular like Moritz's, but follow your rules. You can't do better.
That is absolutely true. So on that note, we're going to wrap up this week's conversation. We hope that you enjoyed it. Keep your questions coming, sending them to info@toptradersunplugged.com or send us a tweet. And if you like what you heard, please help others discover the show by leaving a rating and review on iTunes. And please share this episode with a like-minded friend. One share is all we ask for. From Jerry, Moritz, and me, thanks so much for listening. And we look forward to being back with you and Moritz Seibert next week on the Systematic Investor. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.